Hello, everybody. Welcome to Working Man Investor. On this channel, we discuss the economic environment and how it affects the average person and the steps that we can take to protect ourselves and our families. Today's episode is going to be about mortgage rates. I've had some people ask me why, even though the Federal Reserve has been cutting interest rates, why mortgage rates have continued to go up. They misunderstood that the Fed cutting rates affects the 30-year mortgage. It often doesn't. When the Fed cuts rates, what they cut is the Fed funds rate, which is the rates banks loan to each other to manage certain things such as liquidity and satisfy the regulatory requirements put forth by the U.S. government. So this means it's an interest rate on a very short-term loan. Interest rates on short-term loans move very closely with the Fed funds rate. However, the 30-year mortgage is a longer duration loan and has a different rate at which market participants are willing to lend into. So the 30-year mortgage is the benchmark to the 10-year treasury note. As the rate on the 10-year treasury moves, mortgage rates follow. Therefore, movement in the 10-year treasury has a larger impact on mortgage rates than the Federal Reserve rate. So what is the 10-year treasury? What determines its rate? The 10-year treasury is just a debt obligation that is issued by the Treasury Department of the United States government and comes with the maturity date, obviously, of 10 years. It'll pay interest every 6 months at a fixed rate. That rate is going to be determined at the initial issuance. What are they sold at? They go to auction and they're sold. All treasuries are sold at auction. The treasuries are considered the safest investment there is out there because it's guaranteed by the U.S. Treasury Department. The rates are determined by several factors: fiscal policy, economic growth, inflation. The ultimate one, in my opinion, is supply and demand. Treasuries, they're sold at auction. The more buyers you have at the auction willing to buy the treasury, the cheaper the treasury is going to be, and the less the yield is going to pay. The yield is the interest rate. So if you have a bunch of people bidding on these treasuries, the price is going to go down, and the yield will go down. The price will go up, and the yield will go down. Opposite is found if you have fewer people bidding on them and you have more treasuries, yield will go up and the price will go down to try to attract more people into it to buy. So the 10-year treasury and mortgage-backed securities, they often compete for the same investors, people that prefer safe liquid assets. Therefore, the 10-year treasury yield often moves in tandem with mortgage rates. Investors in these capital markets that buy mortgage-backed securities do need to be incentivized to purchase these mortgage-backed securities because they are slightly riskier than the 10-year yield. Therefore, mortgage-backed securities usually come with a higher interest rate, which over the past 5 years has averaged 2.25%. That's known as the spread, the difference between the 10-year treasury interest rate or yield and mortgage-backed securities interest rate or yield. It's the spread. Now, they have to do this to keep interest in the mortgage-backed securities, keep it as an option compared to U.S. treasuries. So how mortgage-backed securities created? Mortgage-backed securities are investments similar to bonds. Each mortgage-backed security is a share of a bundle of home loans and other real estate debt bought from banks or government entities that issue them. Investors in mortgage-backed securities receive periodic payments, just like bond coupon payments. So the best way, I think, to understand a mortgage-backed security is to see how they're formed in the first place. So there's multiple steps. This first is the origination. Very simple. You go to a bank, a customer goes to the bank, gets out a loan, they secure the loan to the property. Next is they're pooled. So the bank takes all of these mortgages, they all have similar interest rates, similar payoff dates, and they pool them together. And then they're sold to a trust, like Fannie or Freddie Mac, who structures them into a security, a mortgage-backed security. At that point, they're sold to investors. Company services the mortgages and pays the investors every 6 months their interest rate. So the next question I often get with this is, why are mortgages sold in the first place? Well, there's two reasons. One is liquidity, and of course, profitability. Banks need to keep money on hand to meet the cash reserve requirements and have cash to hand out to their customers. You go into the bank, you want money to take money out, the bank needs to have it to give it to you. So by selling these mortgages, they bring money in and it allows them to have capital to do this. And when they sell it, they get a nice commission. So they get more money to create more loans. They then in turn sell those more loans in a mortgage-backed security, and the cycle just keeps repeating. So in a nutshell, selling loans is going to be more profitable than just simply holding on to a mortgage for 30 years and collecting interest on it. It's a better use of their capital to loan money, package them, sell them to Fannie or Freddie to be sold as mortgage-backed security. Keeps liquidity in the system too. It allows for more loans to be made. So we're not going into banks and, asking for a loan. They run a credit report, look at our down payment, be like, yeah, you qualify, but we don't have the money to loan you. Come back and see us in 5 years. That's not efficient. So unfortunately, the mortgage-backed securities is an effective use of capital. If you're a real estate investor or wanting to purchase a house for home ownership, it's better to watch the 10-year treasury and just know that there's going to be a spread between the 10-year treasury and current mortgage rates, and the mortgage rates are always going to be higher because mortgage rates carry more risk than the 10-year treasury. But the 10-year treasury will give you a good idea of where mortgage rates are headed in the future.